Today's CPE Study Circle meeting on internal financial controls, why it is integral to good governance. Gokul Dixit sir will take us through this topic. He is a fellow member of our institute. He also holds an MBA from University of Michigan, Ross School of Business. Presently, he is a managing partner in LLP firm at Chennai. He was an independent director on board of Asset Reconstruction India Private Limited. He was an advisor to Tamil Nadu Infrastructure Development Fund. He was also an assurance and risk consulting in a Big Four firm. He was into forensic audit for Sultanate of Brunei Treasury and government classified accounts. Filed affidavit in Brunei and United Kingdom courts. He was a treasury analyst at General Motors Treasurer's Office, New York. He was also a principal and investment member in private equity firms in New York. He has over 9 years of working experience in the United States in M&A, capital raising and investment management. With this prelude, I present the speaker to the compact audience. Please put your hands together to welcome the speaker. Before I leave the floor to the speaker, let us rise for ICE motto.
Yaesha sukteshu jagrati Yaesha sukteshu jagrati Kamam 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 kamusho Pusho nirmimana Tadeva shukram Tadbrahma Tasmin lokaha shitah sarve taduna tyaryetascha etadvaita
Thank you, delegates. Over to Dixit sir.
Good evening, members. Gokul Dixit here. Thank you all for coming, and this is one of my first presentations in the institute itself. I have spoken many years ago as a student, and coming back here to speak as one of the members gives me a lot of privilege. Thank you. When I was asked to choose a topic for presentation, I said that I would like to focus on this specific topic because one is I've been doing some work related to governance in various facets over the last couple of years, and I see that our profession is also undergoing a big change, and probably I think this topic would be relevant for the times we are in. Why that is so, I will walk you through some of the slides here, which will probably sensitize you a little more to how governance plays an important role in the CA profession, and internal financial controls is at the heart of it. But I have another objective also, and that is, I feel that IFC is also a work in progress, and this is going to lead us to something more in the future. And if time permits, I would like to talk about new opportunities on the horizon also as IFC experts, what doors opens for us in the corporate world. I think if there is some awareness created during these sessions, I would feel that my purpose is achieved. Again, I qualified as a chartered accountant almost 20 years ago, and I keep saying this to a lot of batches of professionals, and I look at people here, and you're all, many of you have passed out probably many years before me also, so I have to be guarded in what I say, because I think the level of wisdom is much more on this side than here. But what I keep telling the youngsters who graduate and go out of my office, and if I have a chance to interact with youngsters in the profession, people who are aspiring to complete chartered accountancy, people who have just finished, is that the way the profession looked in 1999 when I finished is extremely different from 2019. And as a young chartered accountant, when I finished just before the turn of the millennium, if I had a certain aspiration and a goal as a young chartered accountant and said that these are the 2 or 3 areas that I would like to build my career in as a budding chartered accountant, I can say that some of these are even obsolete at this point of time, and those opportunities don't exist for the profession at all. And I think that kind of metamorphosis is still continuing, simply because audit was the core of our profession for many years. I think since its formation till the 80s and 90s, audit was extremely important. And then came the advent of technology, which changed things a little bit, because there was a lot of automation and there was a lot of displacement of manual work done by information systems, and therefore there was a certain level of progression. And this is not just restricted to India, obviously it is across the world, and I've had the opportunity and the good fortune of having seen this in at least some of the advanced countries. I've worked a lot in North America and Western Europe, where the level of maturity of the profession in accounting and finance is definitely more than what it is in India, although we've not done badly and we've kept good pace. But the advent of information systems, we thought, was really the pinnacle which would vault our profession to the next level. Definitely a lot of changes have happened, but when automation came in, I think the amount of change that happened has been much more than just the introduction of information systems. What I mean by automation is what we today call AI, but even simple automation that came even a decade back, when youngsters like me used to write. The biggest excitement for us at that point of time was, can you write macros in Excel and robotize, or I don't know the right word for it, automate a lot of monotonous processes. And this was really the advent of, or rather the just after the BPOs started coming in and doing a lot of work, and the initial phase of BPOs was just body shopping. But after a point of time, it became efficiency, productivity, how quickly can you turn around a job, and that was the excitement for us. It used to be the adrenal rush for us to write a lot of complex steps into a macro and learn SQLs and use access databases, and how well can you perform all that. Now that also is passed, because I don't know how many of you are familiar, like you have programming languages like Python and all that, so with that you can easily mine a data lake so easily today. And there are several companies in India also which I am close to. I mean, the last 4 years I'm more local than global, so I've been working a lot with Indian companies. For example, there is a very important institution of our country just down the road in T Nagar. I mean, not this road, but it's in T Nagar, National Payments Corporation of India. I'm sure you've all heard about it. They have been the pioneers for the RuPay card, Beam payment, and then the UPI, which allows individual users of bank accounts to actually transact with each other directly, and they manage the entire interface for that. Their thinking and their ability to process data has gone far beyond what even some of the Western companies are doing today. And I'm sorry, I'm making this a long introduction. It's not that I'm not covering ground. We'll definitely go through my slides, but want to set some context here. And I just want to share an anecdote that there was a very senior management member of this organization who I had a chance to interact with very closely. And apparently this was probably sometime in 2017 that he was called by the union government and told that you are part of National Payments Corporation, there is an important visitor who is coming to visit us, and I would like you to be able to give him a 20-minute presentation and interact for another 10 minutes. So you have a 30-minute slot to talk about what National Payments Corporation is doing, and we feel very proud about. I think by that time UPI had already come. I don't know if RuPay card was introduced, but there was some. They apparently work on 70-80 projects, so there is a lot more that's going to come. But at that point of time, I think they had made a mark in a few areas. So he said, why don't you come and speak with this gentleman? They didn't give any details on who that visitor was. They just said you have a 30-minute agenda. So this gentleman lands up in Delhi and he's fully prepared for the presentation. And when he walks into the room, it's Nandan Nilekani who was there, basically the ex-chairman of Infosys. And so he thought, okay, this is the important visitor, but what do I know that Mr. Nilekani doesn't already know? So anyway, still he was quite excited about the opportunity. So he was then taken into the presentation room. Then he gets his presentation ready, and then walks in Mr. Bill Gates. So he was the important visitor that had come to India, probably for other purposes, but one of the agendas was to learn about how data analytics and mass processing of data works in India, or how India is geared up for it. So the presentation started. He talked about what NPCI does. I don't want to get into too many details. I've actually done work with them. I know what they do, but I don't think this is the right forum for me to talk about that. But he spoke about how this particular gentleman who was presenting has had a long banking career, so he knows how bank transaction processing works for large banks in India. And so he was able to give the inside view of banking, the outside view of consumer finance, how data transaction processing is happening, and how a database and data centers are managed within the construct of what the Indian government permits, and so on and so forth. So what he said was, what was supposed to be a 20-minute presentation and a 10-minute interaction went on for 2.5 hours. Bill Gates was with him in the room all this while, and he said the closing comments from Mr. Bill Gates was that you are going to put MasterCard and Visa out of business because you have gone so far ahead of the curve, and probably because of last mover advantage, your ability to cheaply process transactions is going to put these well-established multi-billion-dollar companies out of business in no time. So that's the kind of change that has come into transactions, which means data processing, which then leads to how do you account it, how do you report it. And I would say that is something that would be the underpinning of this presentation today. Just one other small anecdote. November 8th of whichever year that was, the demonetization happened, right? 2016 probably. November 8th is my birthday, so I remember it. So 2016 it happened, and at that point of time, NPCI's transaction processing overnight went up by 1000%. If I remember right, at that point of time, say from November 9th or during the month of November, they had to process literally 18 million transactions every day. And since then, I think it has gone up to 2 or 3 times that number. And they said that it was a real struggle for them, but they were able to manage it. And I had a chance to talk with their digital officer, and he said that they were fully geared up for a contingency plan like that, and not a single transaction was misprocessed by them during that time. And probably after that they stabilized by 2017, so things went to normal, because when you process such large amounts of data, it's not only your readiness, it's your counterparty's readiness also, which is equally important. So you really have to put in place a lot of robust systems. And again, I'll tell you, when I talk about counterparty risk, I don't want to give all my anecdotes at the beginning of this presentation, but just one last one, I promise. In September of 2008, Lehman Brothers went down. It was a month when Lehman Brothers was formally declared bankrupt. The same weekend in which AIG was taken over by the government. Fannie Mae and Freddie Mac, two large mortgage companies that are backstopped by the US government, were also put into conservancy. It was all hell breaks loose in that 500-year flood situation. And I was actually part of General Motors treasury group at that point of time, and we had a very small treasury group in New York, which had to manage the finances of this company across about 25 different currencies, placed in several countries across the world. We were managing a debt of approximately $35 billion. We had liquid cash of about $20 billion because this was a time of deep distress for the auto industry in the US. So cash was king and we had to conserve cash, which means that, I mean, you don't obviously keep it as cash, and every overnight we used to send it to Cayman Islands, bring it back next morning for better interest coverage, for being able to cover our supplier payments on time and so on. And there was a whole host of issues. We had 500 tier 1 suppliers, and if we missed one cash payment, the tier 1 suppliers would go into bankruptcy, which means that our supply chains would get affected. So see the magnitude of problems that can happen. And this is a situation where, in fact, I would say in July, anywhere from March to September of 2008, every weekend you would expect the Fed to announce some big company going bankrupt. And they would do it only on a weekend. They would do it on a Friday evening, so that by Monday morning the system is stabilized. So Bank of America took over Wachovia on a weekend, Washington Mutual was taken over on a weekend, Merrill Lynch went down on a weekend, Bear Stearns went down on a weekend, and this was Lehman Brothers' turn. After all this happened over several months, it was Lehman Brothers and AIG. Simply because of their size, this was the biggest weekend of all those bad weekends. Because, I mean, you can imagine one bank going down, but AIG is like equal to LIC of India. So, you know, it's several times bigger than any of the other entities. And by then the problems have become unmanageable. Anyway, that's a totally different story. The thing was, we were all called back into the office on that Friday night to say that, you know, the biggest issue for us was literally the whole of Wall Street and every single financial services company and a financial company in New York was working all of that weekend, because when Monday morning opens, the Fed wanted to know who's holding whose counterparty risk. So I entered into a currency swap. I'm General Motors, you are Royal Bank of Scotland, Royal Bank of Canada, and there are 500 banks. So I think that, okay, if I have bought a currency option, I have bought an option to buy dollars from you. You have written that option, and therefore you hold that liability or a potential liability in your bank account. But the US market had demutualized to such an extent that there was a big wholesale market, which means that 500 contracts which were written by the Royal Bank of Scotland were packaged into a beautiful instrument called the collateralized debt obligation, and that was sliced into various tranches, and tranches were sold to other small retail banks like Capital One and some small insurance companies. And these companies, holding such obligations in their balance sheet, decided to further syndicate it out, and some retail, some cooperative or some municipality in Dallas had subscribed to these muni bonds which had backstopped this liability. So the risk was so far spread out, and you had to literally, every single contract, you had to contact your counterparty and find out, are you really holding my contract? I'm the buyer of this contract. Are you really the seller of this contract and still holding it? You would say, no, I'm not. I've actually sold it on to X, and X has sold it on to Y, and Y has sold it on to somebody else. Even in some cases, very funnily, it's happened that I've bought back the same contract. So it's a contra entry in my book. I've had to cancel it. I'm trying to oversimplify what happened, but again, I'm coming back to the same point. Where is the control? Transactions have happened. Where is the reporting? And if you remember, Lehman Brothers was taken down only because of their accounting fudge. Forget everything else. It was a beautiful accounting fudge where at the end of every quarter they transfer liabilities out of their books and take it back on April 1st, say it was March 31st. So March 31st, the liability goes out of their window, April 1st it comes back. This is how they were hiding their real liabilities and portraying that they were in a better situation than they actually were.
The liabilities goes out means that should be NPS.
I will show you one example of.
Some capital reserve they show it as the liabilities.
Yes.
When it gets, they are saying the year and it goes out and comes back.
Right.
But where does it go? To transfer to somebody?
Yes, it transfers to somebody. So what happens is, in this case, insurance companies sit on a lot of cash generally, and so they have the ability to put their monies. Okay, so I'll give you. So they have the money to. They have their ability to put money to work for short-term, overnight deposits. Now everybody gets greedy after a point of time. If you put it only to Fed, then you get only that 0.25% or whatever. For me, I want to overreach, so I feel I need 0.6%. So what I will do is I'll buy this liability from Lehman Brothers and give them cash. So it's a simple transaction that will work that way. And I'm an insurance company. I create a variable interest entity in the form of a trust, where I don't have to consolidate that trust into my balance sheet. And so when that trust buys this liability, that liability does not hit me as an insurance company. It stays as an orphan without a parent.
Similar to the Enron, what they...
I have shown the Enron example only here, which I will... So the Thinly Capital, you got the point straight. So it's an Enron. So the remnants of Enron haven't gone yet. It has just morphed into different kinds of entities. But the problem is that the management and the auditors' inability to trace all this in real time continues to remain. And which is why financial reporting, financial controls, and controls specifically over financial reporting has become paramount now. And transaction processing has progressed so much that a human rational mind is not going to stop and say that, you know what, laws have not progressed so much and therefore I will stop transacting. I think if there is an opportunity, we are all rational human beings. If there is an arbitrage, if there is an opportunity to make a profit, if there is an opportunity to innovate in a transaction, we are all going to continue to do it. Can internal financial controls and systems keep pace with the way business is moving? I think that's extremely important, which is what brings me to this topic of governance. Where do you draw a line? How do you say that so much is okay? This is manageable risk, but beyond this, if it goes, it becomes a little unmanageable risk. I think these are all things that the world has already started confronting, and we have people here who are part of some very large firms dealing with large corporates, and they will definitely tell you that several boards are really gasping. They don't understand all this. It is almost like how the US Senate interviewed Mark Zuckerberg. They didn't understand what social media was, and here was a young boy coming and talking to them about social media and social data, and these people had no clue what was going on. Our boards, several large boards are also facing this kind of situation where you see that the ability of consumers to transact has gone far beyond what our tax consultants or our auditors are able to really grasp. And so this is really if you want to look at it very negatively, it's a time bomb. So you don't know where the next crisis is going to come. We thought that Nirav Modi was the pinnacle of crisis, and then last week SBI reported something almost equal in magnitude, things that were undetected for several months. So I think it's a very, very difficult task. But as professionals, it's an opportunity. I mean, it's a very morbid statement to make that in distress is where you find this opportunity. But definitely, we have a very important role to play in this, both in advising companies on how to really make the systems more robust, and also, I think, lead them into newer areas, which I don't want to steal my own thunder. I'll reserve it for some time later in this presentation. But there are certain areas like risk management, like data analytics, and also remote transaction processing, control self-assessment, which some companies are very, very diligently practicing because they see this risk on the horizon much more than some other companies. And if I have a chance, I'll talk about those also. So anyway, let's get to the brass tacks, the contents of the presentation. See, I prepared a very detailed presentation, so I can go on and talk about standards of auditing and section 135 and section 143 and so on. But I thought, and I was advised that that should not be the focus of this presentation, because definitely many of you with grayer hairs in mind have seen this much more. Our youngsters who are here are probably more, I mean, you passed your exams later than me, so you're more familiar with the sections and the codes. So I will neither venture into any of these areas, but I will stick to governance and how financial controls impacts governance. What I mean is, I will probably break from my own schedule of contents and probably highlight areas which I feel are important in the context of this presentation. But I would, it would be great for me if this was an interactive session, because I don't want it to be a monologue. I don't want to pretend that I know a lot more than you. I would like that if you have some of your own anecdotes, please let's talk about it and let's share the knowledge across the floor. In any case, for housekeeping's sake, I'll quickly go through some of the essential parts of what internal financial controls is. Of course, the genesis in the Indian context is the Companies Act. There is section 134 which sets the context for internal financial controls. It defines what internal financial controls is. It also talks about what management's responsibility in internal financial controls is. It talks about what we should, what the directors have to present to the shareholders. So let me stop here and ask you something. We've all done audits, right? I mean, either we're still in the profession or at some point we've been auditors. So who really is our stakeholder, in the sense when you're writing an audit report or signing off on an audit report, who are you addressing it to? Who's the stakeholder of that financial statement that you are preparing this for?
Members. They are addressing to members.
To the members, which is the shareholders. So we are all clear, right? The shareholder is the primary. So he is our real auditee. He or she, the shareholder, is our real auditee. Now, who else? I mean, this is how it has been for a long time, and this is 99% correct. But there are also other stakeholders of the financial statements who have a right to question us about what has been disclosed and what opinion we've given on the statements.
So the next is about banks, creditors. Creditors.
I would put creditors as next, yes. Anybody else? Yes, banks, but I would say that is a creditor. Investor also in some ways is a shareholder or a creditor, depending on what instrument they have invested into. Who else would you say is...
regulatory bodies.
Okay. I can contest that, but there's another very important stakeholder in this. Employees, to the extent that, see, that way the whole world is a stakeholder. But what I mean is, okay, if an employee is part of an ESOP trust, then you can say that yes, as a shareholder, then you're a fiduciary to them. But there is one other important stakeholder, which is the government. And so that has come into prominence only after IFC really came in through the Companies Act 2013. Because until then, there were certain provisions of the Companies Act where you had to go back to the companies, to the government to get permissions. For example, managing directors' remuneration being one of the most important ones. Some parts of Section 394 also had government agencies involved in that. Judiciary also included. But really, government came into the fore only in Companies Act 2013 as a big stakeholder of the financial statement, saying no longer can the management or the auditor willfully commit transgressions on financial statements. I'm very carefully choosing my words, and then not be accountable to us. So government became a big stakeholder in this, and that's where that was, and why they became, I'm going to come back to in a few slides here, but that's when they really stipulated through the Companies Act 2013 to say that, you know, directors have to explicitly issue a responsibility statement saying that internal financial controls are functioning well, and auditors have to give a supplementary opinion on this, and therefore you are responsible directly for disclosures that are made in the financial statements. And again, coming back to 134 and 143, these are the sections that primarily deal with this. Now, I've talked about IFC defined here. If you look at what IFC defines and look at the bold words here, you will see that, of course, all of this, for example, safeguarding of assets, prevention and detection of frauds and errors, accuracy and completeness, all of this have a bearing on financial reporting. That is one dimension to it. But the other important dimension also is that, so the other important dimension here is almost all of this falls squarely on the plate of any board of directors, irrespective of whether financial reporting, IFC exists or not, whether a Companies Act 134 came into being or not. All of this squarely falls into the agenda of a board on an annual basis. Policies and procedures set the tone for the control environment that the company creates. So, in many cases, the advent of Companies Act 2013 led to a lot of boards saying, wait a minute, we don't even have a proper policy on financial reporting yet. We've always left it to the auditors, and then they've come up with suggestions, whereas we are supposed to own the financial statements, they are only supposed to express an opinion on the financial statements. But here is the Act itself saying that we have to issue a responsibility statement, and the responsibility statement clearly says that you have to comment or assert on the financial controls working properly, and which means that are there policies and procedures in place for us on financial reporting, on financial close process, on each of the components of the financial controls, which starting from your revenue management all the way down to financial close. Have we set a control environment in place? Do we know what the control activities are? And therefore, do we have a sense of what is the stratification of risks? Is there a delegation matrix as to who in my organization is going to be responsible for any misreporting that happens here? Is there a mitigation plan? Is there an automatic control or a manual control? How are we mitigating this risk? And finally, what is the residual risk? All of this, which was totally swept under the carpet, has gained prominence only because the financial controls was an all-encompassing definition, and it was mandated in section 134 of the Companies Act through a very simple but a very comprehensive definition. So I've just broken that down into the various steps here, and I would again emphasize this. It's pretty self-explanatory, so I don't think I need to explain to you what policies and procedures are and what orderly and efficient conduct is. But what the overarching message here is that if you want to stand by the integrity of your numbers which are financially reported, then obviously it has to be a top-down approach. The board has to set the organization's control environment and the culture in place for correct reporting, timely reporting, and the accuracy, and they are really the people that would be in the first line of defense if at all one of the stakeholders of their financial statements were to question the financial statements or sue the company in court. They would really be the first line of defense to be able to assert that we stand by what we are saying. Then comes the audit assertions. So on the strength of the financial statements, the auditors also provide an opinion, which means that we as auditors are going to perform our audit steps. For this, we obviously rely on the the representation given by the board, but that is not sufficient. Companies Act is very clear. The rules of the Companies Act are very clear, which I have put down in the next table here, saying that you still have to perform your control activities or do the walkthrough tests or look at evidences coming out of those walkthrough tests and be convinced that for the nature of company, the nature of its operations, the size and complexity, the steps that have been performed and the results of those sampling analysis is commensurate with what you perceive as the risk for the company. So the assertions which the auditors go by is what is put on the left side here. I think I have the next slide on that, if so I will just jump to that. So what I put in the left side of the previous slide is all here. So these are the audit assertions which lead to your confirmation that the financial reporting is in order. So it's again existence and occurrence of a transaction, the rights and obligations, meaning exactly what I just talked about 10-15 minutes ago. In this case of counterparty risk, for example, where do really the rights and obligations sit? In terms of revenue recognition, now Ind AS 115 has also come and they've dealt a lot about this. Who really holds the risks and rewards of a particular transaction? At what point does it pass from company A, who's the seller of a good or a service, on to company B, who's the recipient, and therefore who holds the rights and obligations as at the date of the financial statements. So what you would do is you would do certain tests as an auditor to be able to confirm that assertion. Completeness of transactions, accuracy, valuation, which means what is the value at which you are recording these transactions. Again, today in the age of leases and derivative transactions, you have, and Ind AS itself, if you look at even recording of doubtful receivables, there is a lot of an impairment of assets, for example. The valuation has become extremely important because pension liabilities is another example. It's become so important. What are the assumptions that you use for the valuation? The discount rate can swing the value of assets widely, and so valuation is a very important audit assertion that you have to do tests for. And then presentation and disclosures. So a lot more focus has been brought through these two sections. These are two pivotal sections which have brought a lot of focus and added responsibilities onto the management and the auditor, and how we manage this and how diligent we stay to be able to meet these obligations determine the veracity of the financial statements. Now I'm going to go back a little bit into history again. The reason for this is to talk about, we had internal controls all the time, right? See, there was, back in the days before 2001 when Enron happened, when the world was very pure, we also at that point of time had an internal audit process. We knew what internal controls were. So are we just, is it just old wine in a new bottle, or is this really an attempt to reconfigure how audit should be done or how companies should conduct themselves, or what is really the purpose, what is the genesis of internal financial controls? And I would probably take this back to a very important act that was passed in the US in 2002, which is Sarbanes-Oxley. Anybody here has done a Sarbanes-Oxley implementation or worked on SOX projects? Anybody has any experience to share about the nature of industry you are in or specific issues that you've dealt with? So Sarbanes-Oxley, I would say in many ways was a precursor for what we then later adopted in a very modified form as IFC, because Sarbanes-Oxley came in 2002. IFC came several years later. I think only in 2011 we started drafting this version of the Companies Act, and we started giving a lot more thought to it. But in 2002 it was really thought of as the only solution to all the misreporting that was happening in financial statements across the US mainly. Some of it in Europe also. In fact, in Europe, the problem started to surface a little later, only in 2004 to 2007. But in US 2000, 2001, there were several corporate scandals. I mean, it was a mini 2008 crisis that happened at that point of time. And the biggest name of which was Enron, as Sir had mentioned there. But there were also other companies. Now, before I go to the next slide, Title 3, the last tab there which I have put down, really that's when first time companies across the US and SEC also woke up at that point of time, said that the management really has to own specific statutory responsibility for financial statements. And it was one of those rare occasions after several years where a CFO of a very large corporation, here being Enron, actually was imprisoned and he's still serving his sentence. You would until then have very rarely found, it was mostly, and US by nature is a very caveat emptor society, which means buyer beware. It's a very consumer society. It says that, okay, you are a reader of the financial statements. If you didn't have the smartness to read it and you made a mistake, so you are the one who has to suffer. This goes to almost, this is at the heart of the very, very capitalistic society that the US is, where it's very difficult to sue a company also for a faulty product. I think until the tobacco companies got into big litigation, you would have very rarely found companies, owning up to their mistakes and saying that yes, we committed a fraud, we made a faulty product. It was always caveat emptor, US, buyer beware. Same thing goes to financial statements also. So it always was, you were not a smart investor, you were not a good reader of the financial statements, and that gave a free hand for companies to play around with financial statements, gave a free hand for auditors also to take umbrage over this. It's just a culture that had set in. I mean, in hindsight, it's very easy to point fingers and say, you know what, somebody didn't do a good job of it. But really, at one point of time, things had reached a pinnacle. I think, when the situation really goes to a certain point where you see that, okay, thus far and no further, like surgical strikes, you say, okay, this is all I can take. At some point, I have to set the system right. So this was one point, and the biggest poster boy of the major corporate scandals that happened in the US was Enron. But there were other companies also. In fact, if you were in the US reading your New York Times and Wall Street Journal on a daily basis, you would find that Enron was only one of them. There was WorldCom, there was Disney also. In Europe there was Parmalat, and there were some audit firms also which got into problems. But really Enron was the biggest one. And I'm sorry, I'm taking individual firm names here. Arthur Andersen, I was employed with Arthur Andersen in 2001. So not that, I mean, I was in India and Singapore at that point of time. I was seconded to the Singapore office. So we were far away from where the earthquake was, where the epicenter was. But really the firm went down. I was an employee of Arthur Andersen and the firm was dissolved. So I have seen a little bit of this, lived in the periphery of the cyclone. And it was really a dramatic collapse. But it was really, in today's day and age, with so much of Sarbanes-Oxley and IFC having such an important part, I would be very surprised if there was another Enron, because I think we have traveled quite a bit. But here was a company, a utility trader, a very, very aggressive young company based in Houston, which is really the biggest oil trading, energy trading market in the whole of United States, where contracts worth several $1 trillion are exchanged on a daily basis. And this was the early age of the derivatives market, and nobody was really familiar with a lot of derivatives which had very little liquidity at that point of time, so price discovery was a big problem. And Enron literally blew through every kind of audit assertion which we talked about. Accuracy of contracts, no, it could be played around with. Valuation of contracts, you could make your own assumptions on transactions. Completeness, no. Sometimes one part of the transaction is booked, another part of the transaction is not booked at all. So there was every kind of violation which was so apparent there, but simply because there wasn't any conscious law to protect this, there was a free hand given to the company to misstate its books, and things just piled up over a period of time. I mean, we've all read here in the newspapers about how Satyam scandal happened not just in one quarter, it was a build-up of several years. This was something similar. It happened over several years. So what exactly happened was, I have tried to explain, oversimplify this and explain it very, very, at a very high level. So, Enron as a company has receivables, and let's say they have $1 billion of receivables. Mainly, this is receivables from individual energy consuming customers. So, all these customers have to pay their electricity bills, and like I described a little earlier, you collate all these receivables, create a collateralized debt obligation or some other securitized instrument, sell it off to somebody else, and then there is this big Enron, a financial powerhouse which would come and buy those assets or the future receivables at a discounted price, and they would be able to stay and hold these receivables and collect the money and therefore make money from their interest. So this is what Enron was doing or supposed to be doing. But what they did was they got a little greedy. So let's say I have $1 billion, I'm Enron, I have $1 billion of receivables sitting in my books. They created thinly capitalized entities, and these are called variable interest entities under the FASB, under the US GAAP, variable interest entities. So what a thinly capitalized entity is what I have described in an illustrative balance sheet. If you look at the left side of this, say I need $1 billion of capital in my balance sheet. What I do is, I capitalize this company with equity share capital of $10 million, 1% of the total funds that I need. 99% is debt. So that's how I create my liquidity for $1 billion. Now, how do I create this equity and debt of $1 billion is, I get hold of, I have put a bank trust here, but it's not as simple as that. This has been done through several secondary financial agencies, insurance companies. There is a whole network. There are syndicated LBO investors who are part of this, but I'm saying it's a bank trust. So they created a bank trust. The bank created a bank trust and said, I will hold 99% of your share capital, which means out of the $10 million of equity that this entity is going to, this variable interest entity, or this, let's call it, give it any name. It's non-Enron, so it's had got nothing to do with Enron. It's an arm's length entity, unrelated party. Say let's call it XYZ Corporation. So this XYZ Corporation has an equity capital of $10 million, out of which 99% of this equity is contributed by the bank trust. 1% of this equity is only coming from Enron. So Enron is really putting in only $100,000 into this entity as equity share capital. But out of the debt that is created for $990 million, Enron is putting in $989 million of debt into this company. So this is a thinly capitalized entity. It's a variable interest entity. What this does for Enron and what this does for a bank, can you imagine as accountants for a minute? As Enron, does this have to ever show up in your financial statements, even if you consolidate your financial statements? I'm talking about pre-2001.
It is less than 3%, they need not consolidate at that time.
Yes, exactly. If it is a less than 3% company, they need not capitalize it, they need not consolidate it.
Whereas in the case of the bank, they have to consolidate, therefore they are putting more equity so that they are consolidating.
Right. So Enron does not have to capitalize, consolidate this entity, and so in Enron's books, these receivables don't appear at all. But the beauty of this was, the bank also found out a mechanism where they need not capitalize this. So they also created variable entities of several layers and diluted their holding, ultimate beneficial holding, to less than 3%, whereby they also said, we will also not consolidate these entities. So that's what I said, it's an orphan entity which is owned by nobody at the end of the day. But the bank indirectly is financing Enron, which is then financing these entities, and therefore it is buying more and more liabilities from the market, pushing it into these entities, and so over a period of time you are building the receivables in these entities. And it's a typical, then it becomes a typical well-tested, the old Ponzi scheme, where you don't collect these receivables on time because some of these receivables are really low grade. Say you get into subprime receivables where the collection itself is uncertain, and then you are getting into not direct receivables or consumers, you're getting into receivables which were packaged, probably the more than 180-day receivables of these banks are getting offloaded into some of these CDOs, which were what you were investing into, and therefore that cash generation or the collection of the $1 billion does not happen in time for you to be able to sponsor the next purchase of $1 billion, and therefore what you go and do is you borrow more debt, and then you start building up the receivables in your books. Liabilities don't build up in your books, and therefore your equity starts showing up, reserves start building up, as though you have been able to offload this as a discount and build your asset side of the balance sheet. And beyond a point of time, you can't really manage this. It's the typical Ponzi scheme. But the point is, where did the controls fail in this? I mean, we still had internal controls back in those days also, but where did it really fail? It was
We evaluated, probably they have never applied in mind, just gone by whatever have been produced and then signed.
right. So, I mean, where would you lay the blame for this? Is it the board? Is it the CFO? At what level would you say that there was?
The CFO with the auditors, probably auditors also I think very responsible.
Right. Auditors definitely were to blame, which is why at the end of the day Anderson went down. Fair. I think that was fair justice that was done. CFO also went to jail, so probably fair justice was done. But what was the role of the board in that case? Should they have foreseen this? Should they have, what checks and balances should they have placed? You think that something could have solved this problem?
The whole-time directors, I mean the CEO could have done, or he may be in complicity.
Obviously there was complicity in this case, but really right now whatever we are grappling with is what the US justice system itself was grappling with at that point of time, because they really didn't know how to pinpoint the blame. Okay, you liquidated the audit firm, you put the CFO behind bars, or at that point of time he was under trial, but then what? I mean, why do you really have, what is the raison d'etre for the board? Then why do they need to exist? So that's why these questions started getting asked, and saying that, is the board really then responsible for governance? We've been only playing lip service to it, and therefore Sarbanes-Oxley was coined with the specific purpose of saying that, at this point of time we really need to fix responsibilities, and it has to be a top-down fixation of responsibilities. You will have to make the board, which is responsible for ultimate governance.
As I said, I'm not very familiar. As I understand, all the big fours, whatever mistakes they commit, they can pay off, the compensation or a penalty or whatever it is, and they are let off. It's already put in their website. That's all. So no other actions are there. It's printed in a money method.
So you are getting into the realm of judiciary, which is not where I want to comment.
No, what I'm saying is, that's how is a very important point. So you made a mistake, okay, you pay off this amount, so I'm let off.
I mean, it's very difficult. In fact, in the Arthur Andersen case, for example, why the firm went down was not when the Enron scandal happened. Arthur Andersen was very confident that nothing would happen to the firm because they had a very strong balance sheet themselves and they had liability insurance. So they were very confident that we will weather the Enron storm. And I'm giving you the view of the Asian partners of Arthur Andersen. Obviously, the US partners were in the middle of this, so I don't know how confident they were. But we did ask our leadership these questions. EMEA was one group at that point of time, Europe, Middle East and Africa. So we did have a chance to interact with the EMEA leadership of Arthur Andersen, and we asked what will be the implication of this, and all of them were quite confident. They said, the US's office of Arthur Andersen is handling this, we'll be able to, our liability insurance will protect us and so on. But where the problem started was when it became a criminal investigation.
They are destroying this, all the document in one day.
Exactly.
One big machine.
Yes.
And also they are contracted and destroyed.
So the Houston office actually shred documents, and then the US Department of Justice said you're actually concealing or destroying evidence, and so it's no longer a civil suit, it's a criminal suit against the firm. And when it becomes a criminal suit of an audit firm, no matter how widespread you are, then there is your personal liabilities start to count. Then every individual affiliate in every country started to dissipate and say we don't want to have any association with the US firm, and that's how the firm disintegrated. I don't want to make sweeping statements about multinational firms or big firms or whatever. I've been part of it, and I mean it's beyond my at least the scope of this discussion, because that we're going into judiciary. But the thing is that even the Justice Department is grappling with how do we fix a responsibility. Even the lawmakers in the US were saying, okay, what really is the purpose? And this is extremely important in today's context, ladies and gentlemen. Why I'm saying this is the nice aspect of internal financial control is, you know, today there's a director's responsibility statement. The auditors have to give an opinion on this. Some boards are really woken up to this. Some companies are really taking this very seriously. But government is fair and square become one of the stakeholders of the financial statements, and I'm a little guarded about how well this is working, because several of us know this very well. The SFIO got created at the same time. What is that? Serious Fraud Investigation Office, or whatever that's called. Even the CA Institute now, after a lot of noises, disciplinary committee has a couple of members, I think, from the investigating agencies like CPE or whatever. We are going through the same situation that happened in the US, where nobody knows really how to pinpoint responsibilities, and I know of cases where auditors have been taken to task where there is really no clear delineation saying, you know, you as an auditor, I mean, we used to, all of us when we wrote our exams, including me when I wrote my exam, I don't know what it stays now, but it was very, very clear that one of the most fundamental principles which was in the standards of auditing at that point of time was, if it is a well-concealed fraud committed by the management, you really can't hold an auditor responsible. So there is only a certain line to which, if I as an auditor have exercised my diligence and I have performed my controls tests and documented it and established my audit assertions are all working fine, then I have enough evidence that I should be acquitted or not being put part of, not be roasted over the coals. How well do our investigating agencies understand this? I mean, it's no longer you're having a dialogue with an informed body like the CA Institute, and I'm not here a torchbearer saying that our institute is perfect and these government agencies are not. But I'm saying, how well do they understand or appreciate this and are able to delineate in their mind with full neutrality, saying that, you know, the company is really the one that should be in the first line of defense. You cannot really haul the auditors over the coals if they have established diligence. And even today I can tell you that the auditors of Satyam privately are very steadfast in saying that, you know what, we've been unfairly put on the pedestal for this and we are unfairly going to the gallows for this. And I'm sure a lot of senior professionals here, you all would have had many conversations with people who've been directly affected by this. But there are several such companies. I mean, you take this whole PNB scandal that happened. I mean, ILF is the latest one. It's not to paint everybody the same brush. I mean, you can't really say that no auditor exercises diligence. That would be a very, very easy way to dismiss our profession. But really, where do you draw this line? It's a constant learning and evolving process, and it's as important for us to educate the people on the government side and the investigation side and the compliance side, which is happening a lot in the US. At least I know that a lot of large audit firms lobby with the SEC at all points of time, and it's in a good way. I mean, lobbying is not always bad, because it's important for them to also understand practical difficulties. Only then you come to a middle ground, and I think it's something that some of us have to also take seriously. I would urge some of the, I think if some of you have some opinion, Bhavani ma'am, if you can also say, I mean, I would say that it's important for somebody like an ICAI to represent more strongly with the government and the investigating agencies and really, you know, remove the bias that exists about our profession, and what are the limitations that we have as auditors.
I don't think that we have a
board where Harinder Singh was chairman and he brought out a book, small book on what is an audit. The idea was that you give it to regulatory authorities, give it to boards of directors who have a perception that the auditor is responsible for the entire network and the entire good health of the company. And it is not restricted in scope. So that booklet had a lot of popularity. That's one of the things which the institute had bought out, but unfortunately it was not publicized even with the sale of publications. It was a small book which was brought out. And if you really see the institute, having worked with those committees, let me tell you, there is a lot of interaction with regulatory people. There are invitees on these committee boards who understand these things from regulatory authorities. They participate in the Auditor's Assurance Board and the Accounting Strategy Board, and they quite understand. But when it comes to a regulatory body that comes out with wordings, it's not necessarily these people who are representatives are probably involved in the decision making.
Right.
That gap needs to be addressed.
Yes. I mean, I can tell you practical instances. I have my senior partner also here. Tell you that we've also faced situations where there was an issue with the company, and so we were called in to for our what do they call it, recording your testimony or whatever it is under oath, and we were tax auditors of a company where we were hauled for some, because it's a true and correct opinion, right? So for some misstatement that happened in these statements, and we were trying to convince them that there are certain limitations in a tax audit, and then there is something called using the opinion of a peer in the industry. So we were trying to really educate them, but this investigating officer was from DRI. So they didn't really understand. Companies Act was way beyond them. I mean, Income Tax Act was way beyond them. So it is very difficult to convince somebody who really comes with a bias and starts looking at you retrospectively and trying to make sense of what you did, working backwards. So I think it's very important to educate the people on all sides. In fact, the legal profession is doing this very well in, especially with intellectual property rights. I know that they're educating the judges quite a bit on IPR, and that's what apparently has led to India's IPR rankings going up over a period of time. That the judgments that were coming out were far more balanced, and I think it looks like IBC is also doing a good job and not making ad hoc judgments. I mean, most of you are familiar with IBC, know what happened about Section 29A, about financial creditors in case of real estate and so on. So the judiciary is also evolving and keeping pace, and I think we have a lot more work to do in terms of financial reporting and financial reporting related investigations that happen. That's anyway a little out of context, but I thought take the liberty of talking about it. I don't want to. I mean, I wish I had a chance to move around. It will make it easier, but I've been given a stationary mic. I mean, I can talk about WorldCom for another half an hour. This was a typical M&A scandal, not very different from how Satyam Computers finally panned out. You're trying to merge an entity and trying to hide some of your liabilities with the reserves that are there in the acquiree company, and and therefore trying to mask some of the liabilities. So, these are all scandals that were the flavor of the season back in 2000, 2001, and so that was when the US said enough of it. I'm happy to share these presentations because if I start going through each slide, I think it will take a lot of time. So I'm just, since we had discussed Enron for so long, I just want to gloss over these a little quickly because I want to get into the second half of this presentation. Almost the big message here I want to leave is, I think if we fast forward to 2017 and come to an Indian context, and I walked through one more Indian example here which will come up in a few slides, and if we follow the internal financial control process diligently, I think a lot of these potential misstatements and avenues for liberty in playing around with valuation of and rights and obligations of assets and liabilities on your balance sheet can be significantly arrested, or it can be brought to the notice of the board more explicitly and within a reasonable period of time. So the board can't claim to be uneducated about it or feel helpless about it, because we can help show the torch on exactly where the problem is likely to occur. And I worked on a very interesting project recently, and this young gentleman sitting here was also a part of that team. And it was very interesting because when we walked into the boardroom to talk about this at the beginning of my engagement, the chairman of that committee, it's a risk management committee, and the chairman said, see, you're going to help us put a risk management framework in place. All I want to do as a part of that is to be able to go back in a very constructive way back to my organization and fix responsibilities with people who would be assigned to watch out for these risks. So it's almost like sitting on a lighthouse and trying to figure out where is the danger lurking around in a watchtower and saying where is the danger coming out at me. So they said that this is really the objective of this. You can come up with a nice risk management framework and say that your organization is subject to X risk, Y risk, so much internal risk, external risk, controllable, non-controllable, financial, non-financial, quantitative, qualitative. You can put whatever fancy things you want. At the end of the day, if I feel, okay, these are my top 10 risks as a business, in that case it was not just restricted to financial reporting, it was business as a whole. I should be able to go back to my organization and say, hey, you are part of my senior management. This particular risk falls squarely within your domain, and therefore it's important for you to be able to track a particular metrics which will help me analyze what the implication on the financial reporting or on my business, on my profitability or whatever is, and therefore plan a contingency and be able to be prepared for this. So that is the level of preparedness that you will have to lead me towards. Only then is yours a completed product. And I feel that that is exactly the same as what financial reporting or internal financial control is supposed to achieve, and it has done its purpose. And if it is followed diligently, and I have some templates at the end to show how this is done in certain companies, it definitely sensitizes the board to say that your real risk lies in one or two of these processes which you need to tighten up, because this can have very high implications. So it's a red risk, or it can have a moderate implication which is an amber or an orange risk, or something that's only in the horizon, it's not such a big risk. So I've covered some of this, so I won't spend too much time, except I'll show you one interesting illustration. Of course, Satyam was our Enron moment in India. Very unfortunate. It was a company that was really doing reasonably well until a point of time when the balance sheet started to grow bigger than the operations, and a hodgepodge merger was tried out that failed, and therefore the company went into a situation where they had to come out and spill the beans. But again here, the day the scandal broke out, or a week or 2 weeks after that, is when 2 board members resigned and said, we never had an idea about what was happening in this company, and you are a board member of this company. If I remember right, one of them was even a financial professional with a very reputed university in the US. And so it was really embarrassing for somebody like him to say that I had no idea that the company was really fudging its books. And at that point of time, again, it was so difficult for anybody to pinpoint blame and say that you should have exercised enough diligence. There was nothing called a director's responsibility statement at that point of time. So only when something like that is mandated, you start to take governance a little more seriously. I mean, I'm no way making any judgment about that particular person who was on the board, but then it makes it a very deliberate exercise and caution. If there is a traffic light, I will stop. If there is no traffic light, I have the tendency to go halfway down the road, check if there is any traffic, and speed up again, right? So that's human nature. So I mean, if there is a law, then it's important that you have a law, it's important that you have clarity in the law, it's important that you implement the law within the confines of what it's meant to be. So I think IFC really puts that structure in place. Now, Satyam was just one episode. we were able to quickly solve it, and I think life moved on. But if you see the NPA crisis is festering a lot more, and I just prepared a simple illustration which has been repeatedly done several times in India, and I would say that this is probably the crux of the NPA problem, which every bank is knowingly or willingly being a participant in this crisis. Not always can you just say that only the promoters are to blame and they're a crook. I think everybody has been a party to this NPA crisis, and we are only now hopefully coming out of it after almost 3-4 years of gut-wrenching pain and restructuring, and hopefully this doesn't spill over into the NBFC world now. But think about this simple illustration. Let's not spend too much time on the top part, but yeah, maybe we can do that very quickly. So there is so number one, I have said there is a project. Let's say it's a power project. 2,000 crores is my cost. I as a promoter know that I can execute this power project for 2,000 crores. I get a project report done where I have inflated the cost conveniently to 2,500 crores. Then I apply to the bank and say, you know what, you have to fund my project. A usual 3:1 debt equity ratio, which is normal for a power industry or a steel industry. You can assume whatever you want. And therefore, out of 2,500 crores, what is it, 600 and something odd crores would be my equity. The balance 1,750 crores is debt, which means that for every 1 rupee that I put in, I can borrow 3 rupees. So what do I do as a very smart promoter? I say, okay, I'm starting my project. I'm breaking ground today. It's a 2-year project. I need to start giving advances to my contractors. So here is my first 20 crores. Which means if I put in 20 crores, banks have to release 60 crores. These are all standard, you worked out because of the DPR and you timed your cash flows. Banks have all signed up on this. The consortium has given you a waterfall model. They've given you a schedule of when they will lend. And so you got your environmental clearance stage 1 or whatever. And so you're saying that, okay, you're eligible to get 60 crores. Now I have 80 crores cash in my hand. I know that at the end of the project, I have 500 crores of buffer to play with. Which is that 500 crores? The actual cost of the project is 2,000 crores. I have inflated the value to 2,500 crores. I'm being very brutally frank here. There are only 50 of us sitting here, so there is no need for us to pretend or hide that this is not happening. We all know that several projects that went into NPA was because this was being played out at a very high level. The connivance of all the parties that are involved. And if I may be permitted to say, the central bank also knew about this, Reserve Bank. At some levels. So now I have this 500 crores of buffer to play around with, and so out of this 80 crores, I start creating my pocket for against that 500 crores right now. Okay, first 80 crores has come in my hand. Let me stash away my 10 crores. Now how do I do it? I create an umbrella contractor company. So I am Gokul Power Company. Now I create my friend, he is my friend here. I tell him, Jai Ganesh and Company, you be my umbrella contractor and I'll pay you a small fee for it. Here is the contract for 50 crores. But Jai Ganesh is specifically told 40 crores is the value that should go to various subcontractors under you. If it is a power project, you have to give some advance money for boiler turbine, you have to give some money for your labor contractors, some money for your transmission lines and your T&D station. So you spend 40 crores out of it. The balance 10 crores, I will tell you what to do. And then you literally start rotating that money across various other companies, all of which are unrelated to me. In the current scheme of things, variable interest entities, you have various other companies. The money finally rotates and somehow it comes back to you. I mean, we are all innovative chartered accountants. I don't need to describe how the money comes back to us. We bring the money back to our books. Now the 10 crores has reached back to me. And that 10 crores I'm putting to the bank and saying, here is another 10 crores, give me 30 crores disbursement. Now I have 40 crores to play with. So what do I do against that 500 crores? I have stashed away 10 crores in my first rotation. The second rotation I will stash away another 10 crores. Now this started playing around again and again and again. Again, like everything else, if the world was moving very nice and efficiently, these people would have all made good, and a lot of people have made good and come out to the other side also happily. But Then you get into land acquisition problems, you get into environmental clearance problems, you get into evacuation of power line problems, you get into coal allocation problems. So the practical real world starts to hit you. The project doesn't get completed. If milestones are not achieved, banks are saying, why should I disburse my next 100 crores to you? If banks are not able to disburse, you have already gone halfway into this project, but you know that there's not enough money. But by that time, another thing has also happened. You were supposed to put in 600 crores as equity into the project. Now I have no skin in the game, because out of the 600 crores, anyway 500 crores is going to come from this surplus which I was going to play around with. So I have no skin in the game to literally continue and try to finish this project. And that is exactly what has happened today. And I am not joking if I tell you this. In 2011, I was part of a private equity fund. I left the fund and joined another fund. So I was, because I was thinking of moving back to India, so there was an opportunity for me to work with another fund, and they had some investments in India. And they had already made these investments, and these investee companies were in problems for one reason or the other. And I had done a lot of operational work. So my fund was not just a financial shop, but we also were operating assets. So I had a lot of operational experience also. So they said, see if you can do something, efficiency improvements, capacity productivity improvements, HR improvements, that's how you turn around an asset. So I went in and saw a project, and whatever I described to you as a basket case happened in this project, and it was not too difficult for us to study it. I mean, you look at, you do a general ledger review and you know how the funds are flowing and how money could have been rotated. And so I promptly went back to the US and reported to my fund saying, it looks like this project is set up for failure, because the promoter doesn't seem to have much skin in the game. And I actually drew this out for him and showed him. I said, this is exactly what is happening. And this was very new for him. I mean, here he is sitting in New York, and it's called helicopter money. When you throw money, when you spray cash, sitting at a distance, it's called helicopter money. So obviously helicopter money never reaches the intended recipient. You never know where it gets sprayed. So I don't know whether he really didn't know about this or he pretended he didn't know about it. But then you start looking at the financial statements of this company, and nowhere would you have figured out that something like this was going on. I mean, it is very difficult for a financial statement to show that something like this was happening. Whereas I'm just fast forwarding it, and there's a nice adage which says life is lived forwards but understood backwards. So then when you start doing postmortem, when you start looking back and saying, how can this have been prevented? I think a diligent IFC system can really address something like this, because then you start looking at control environment, control activities, and then you start doing walkthrough tests. You start looking at whether asset creation is commensurate with the amount of money that has been spent. So then you as a board start to wake up. So again and again, the point I'm trying to make is IFC is not reinventing something that never existed before. I think it is just shining a moonlight on some areas which were taken as granted, or probably there was a certain assumption that internal controls and internal audit to solve problems, or financial statements will automatically show up what the true and fair view of the state of affairs of a company is. IFC is only one more supplement towards that, but a little more deliberate step in saying that there has been a proper deliberate process which is actually showing that what is intended as section 134.3c or 3e and what is section 143.3 is actually being implemented on the ground in paper. And if I am a statutory auditor, I can actually go back and verify what has actually been done by this company to ensure that there is integrity in financial reporting. Financial reporting is backed by actual steps that have been taken by this company to follow my policies and procedures very diligently and create a documentation for it. And there are samples which have been tested. there have been mitigation steps that have been taken, and weaknesses have been addressed. So this only gives an additional layer of protection. I mean, it's a second perimeter around the company's financial reporting process. I think let me take a break now and ask you is, I mean, if anybody has worked on IFC projects here, I would really like you to share some experiences on how your interactions with boards have been about this, how well they are educated. Does anybody have anything to share? Can you talk about any IFC work that you've been part of?
Broadly, people believed that they had all controls in place, everything was there, and this is more of a document creation, that is the initial thinking. When people came out with observations after running through the existing controls and giving suggestions, the reaction, especially for those corporates who are more into a governance space in the form of public governance than family governance, believed that it was just extra work which is to be done, and that's really not necessary, because it was all management by family and a set of components. The third area of resistance or self-denial was whenever somebody pointed out high, medium, low. Even today there is a lot of resistance as to what is high, what is medium, what is low. Why do you say this is high? I know my own. So that is the broad thinking. You could take a percentage of very few of the entire corporates who really take this as an exercise which would value add and which would grow.
Right.
Initially it was very difficult to make people accept this concept.
Right.
Somebody to come and study your controls, because it's just like how the auditing standards changed. When people would not accept sampling but prefer to do 4 months in a year, 1 month in a quarter.
Right.
So that actually this is a change agent's role, right? So it's very difficult to get acceptance.
Sure. I think ma'am has hit the nail on the head. It is really a change agent's role, and that's what I would like really to focus on. I would see, I can go through this and talk about ICFR. I have prepared a lot of slides on how an audit report would look and contents of that, when an adverse opinion should be generated and so on. That is not really what, and I don't want to really stay here till 8:30. I'm not forcing you to do that also. It has to be a one or two takeaways, and I think ma'am has really hit the nail on the head when it says that it's really a change agent role, because that's what ultimately, if you look at it from a management's point of view, and there are certain managements which take this very seriously, they are using this as a way to create more accountability within their organization, because companies have become very big and complex these days. The base of transactions can no longer all fall in place in my daily MIS report. It is virtually impossible for a company to even figure out where things are going wrong. And so there has to be a cultural shift to saying that, as an organization, data integrity is absolutely paramount for us. And I really recognize the fact that robust reporting systems in place have an important role to play in the efficient running of my organization in being able to achieve my corporate goals. So as much as an annual operating plan is taken very seriously by companies, these companies are saying that IFC is also part of the same thing. My annual operating plan, where do I see holes in achieving this operating plan, and let me plug those holes by making my reporting controls extremely robust. But the other question I had is, how many of these boards really appreciate the difference between an internal audit and internal financial control? Internal financial control puts responsibility squarely on their plate. Internal audit is still something that, in the scheme of things, It comes only under an audit committee, which then delegates its role to either the controller or sometimes CFO itself. But internal financial controls really puts the responsibility on the entire board itself. How many of these boards really appreciate the difference between the two? I'm not sure, ma'am. I don't know if what your experience is. I'm sure you've seen a lot more boards, but my general understanding is they view this as another internal audit function, probably a complementary to an audit function, and in some cases it supplements. And like you're saying, some of them are very skeptical. They say it's just another paperwork that you need to do. But there are certain companies. In fact, there is. Sorry. I can't hear you.
So I used to work with a pharma company, a Swiss pharma company in Australia. It's quite a mature market. And in terms of when it goes about what has been streamlined to every function and all your functions makes it responsible. And since it's a very mature market and the toll to the top is really big in terms of the internal controls. So for me, when I look at internal controls from that market, it has been very stabilized. And the process owners or the managers of the department take total responsibility. But I come from a very mature market. Do you get me?
Yes, I got it. Have you been with this company for a long time? Has there been a journey for this company also in terms of realizing?
So this has been, it's a global company, so obviously most of the work is done by the Swiss entities where they have headquarters, and it trickles down across the world. And I was with them for about 5 years. So in terms of the responsibility at the bottom line, everybody is aware. I'm coming from the mature market. I'm from Australia.
Sure. So, what you were just narrating is the Swiss pharma company that had operations in Australia, and obviously they take this as a very serious exercise. And I have seen this realization growing in a lot of multinational companies, simply because they have realized the limits of their capability to micromanage things, and therefore they believe that the system at large, with its checks and balances, would work far better than arbitrary exercise of controls or manual exercise of controls or a lack of structure. So some of them have used IFC or Sarbanes-Oxley or the equivalent pretty well in being able to change the culture of their organization and change the way things have operated. But the real success for all of them will come only when something like internal financial controls is aligned with their corporate objectives itself. It's aligned with their annual operating plan. I think the more they are able to align this, the easier it will be for them to actually say that, now all of us have the same goals in mind, and that's when the true success is. And you'll see a lot of these companies are also very open about criticism or being subject to review, audits, or checks. It is never a culture of you found out something that I have to defend until my death. Rather, okay, you found something wrong, let's see how we can fix the system together. I think that is what ma'am meant by saying change agent, and that has really led to a lot of realization. And actually my last slide is only on that. I don't want to straight away jump that far immediately, but that's something that I was coming to. If you will permit me, I'm going to, I hope we can keep this discussion more interesting than spend all the time going through because I really don't want to go through, like I said, the whole process of, I might as well show you templates. I would like to have the discussions around some live examples and some opportunities that I see coming up in this profession. So if you permit me, I'm going to skip a number of slides. This is one thing that I prepared just to show you that there are tangible deliverables, and I'm just re-emphasizing a point that I've already made, so I won't spend much time. But the section in the Companies Act and the rules now actually specify tangible deliverables that are coming out because of IFC and ICFR. So that really forces us to follow certain procedures and make reporting. And so only when there is a reporting and a certification, then the level of seriousness is far more enhanced. And so, just like Title 3 in Sarbanes-Oxley, We also have specific sections and rules which cast responsibilities both on the management, which means when I say management, I mean the directors, and the auditors also to specifically report, and the kind of companies to whom they are applicable is also listed here. I'll share this presentation. If there's any way to get it, you can have a look at it. If I start on guidance note, I think I can talk till tomorrow morning. So most of what I've already talked about is covered in the guidance note. The only thing I will add is our guidance note has taken a very sensible second level jump just beyond talking about the niceties of our internal financial controls, and they've actually given us some guidance on what kind of samples will you select. So see, the whole IFC process is you set a control environment as a board and you prescribe or sign off on certain control activities which have to be done, which will mitigate control risks, and you then allow an auditor to come in or somebody to come in and perform a check on the design of these controls and find out if there are any inherent control risks, and then obviously they find a mitigation mechanism for it and try to arrest the risk. Now this is what is the process. Now if I have to come in as an outsider and do a review of this, obviously I'll have to see for each process, is there a control activity that exists and how well is it designed. That is one part of it. Then I do a walkthrough of these tests. So if it's a revenue management, then I'll probably pick out invoices and start going through this whole process of order to cash, O to C, which means that right from getting a customer order till I deliver, convert it to cash and realize the money, what are all the steps involved here, where are all the risks, and how well have I mitigated it. Now when I do this, there is a very important point on a walkthrough of tests, walkthrough tests for test of controls. On what basis will I be able to satisfy myself if I am doing an IFC review, or if I am a statutory auditor who is reviewing what an IFC reviewer has done, or me as a management who is going to give a director's responsibility statement. If it's a company like a cement company, let's take a cement company. So from their 75 depots across the country, on a daily basis 30 dispatches of cement go to the various customers. So you do your own math, I'm pretty bad at it, but 75 into 300 working days into 30 invoices every day. So you're talking about a few lakhs of transactions, which constitutes the bulk of my revenue. Now our guidance note has actually done quite a lot of help on determining a math to what the sample size should be for this. So at least they've spent some time and helped us think about this and said, okay, you determine your sample size based on the number of transactions or the value of transactions or the frequency of occurrence. There are various parameters, and this is now part of your IFC documentation and deliverable also, depending on whether you are an auditor or a management, to say that adequate number of samples have been chosen for me to confirm that I have tested this control and it is performing well, or I have a basis to say that there is a control material weakness in the control. So I think that is for me the biggest takeaway from the guidance note. I am not going to spend time here talking about every clause of the guidance note, but if you were to tomorrow get an IFC engagement or talk about it, please go through the sampling section of the guidance note. It's very well drafted, and I would say that beyond taking Sarbanes-Oxley or any other act and reproducing it, our CA Institute has actually gone a step further and said that, okay, let us come up with a method to this madness of how to tackle this and how to put a number to it.
Gokul, there were two path-breaking changes in the auditing standards. One is the risk standards and the other is the internal control. So for both guidances, from our organization, we have been instrumental to developing these guides. For risk of material misstatements, the implementation guide was developed by me, including the revised version, and this internal controls my colleague Balaji has worked on it. What we have done as a background to both is we have taken all the large firms' practices, and we have also looked at the PCOB guidance, the UK guidances on their implementation guides issued by those boards, and incorporated those in preparing this guidance, because our auditing standards curbing the judgment of professionals. So what we decided finally is, we had a lot of arguments with Vijay Kapoor, the then secretary. He wouldn't allow us to publish any implementation guide. Then all the members had to say, unless you give an implementation guide, you cannot expect members to implement these standards, which are very complicated. So then they came to a decision that an auditing standard has a higher authority, but an implementation guide is something which need not go to the council as a whole, but can be approved by the Audit and Assurance Board and put out in the public domain for any comments, and then taken back, and then this implementation guide story started. And that's why the latest standards have got these.
And you've given a number of illustrations there, number of practical illustrations. I think it's a fantastic document and should really thank ma'am for the...
And the small business guide also we came out because the practitioners for small and medium industries to implement all the standards is difficult. So it's easier to have these checklists. And the second version of that, we had a study group from Chennai which had many of the practicing chartered accountants who wanted all the checklists inside that, and we gave it in the CD form. But this implementation guides came out only from SA 300, 315. That's the issue.
Right. I think ma'am, you should be talking here. I would love to listen because... And I would really request if you can do a session for us on that, because I have seen a number of illustrations, and I will tell you that I really use the guidance note and the implementation guide at least as a framework for us to, and we've done at least 10 to 15 listed company IFC work, and it's a phenomenal exercise that we've done. Thank you so much for all the effort. Again, I'm going to gloss over a lot of slides, but another important thing is, I think it's very important for us to educate the management also on what is internal control versus internal financial controls, and not every internal control manifests itself as a financial control, because then you're not really distinguishing between what an internal audit is versus, or internal check is versus what IFC is meant to achieve or ICFR is meant to achieve. So I've just put some examples on where there could be situations which are procedural lapses, which are within the domain of internal control, but really they don't have to come within the purview of IFC, because IFC is specifically only focused on, is there an implication on my financial statements? Is there something, because for example you purchase requisitions or processes, and that's where I was saying a lot of things, when you're saying it's part of my strategic goals, not everything will come under an internal financial control. Internal financial control is specific to, is there a reporting responsibility that's been cast on the management and auditor, and therefore that is germane to this whole internal financial control exercise. So I put some illustrations on that. You can also go through it. A lot of this we've actually spoken about, but rather than explaining this slide, I'll come to the template that I put at the bottom, which will be easier for you to understand. I'm not even covered half of it, that's why I'm going fast. I think we've addressed most of this. I want to get to that section where we show you the samples. See, I keep using this word control environment a lot of times. So I thought it's important for us to understand what that is. But I think ma'am had explained it even more beautifully when she talked about change management. So control environment has got everything to do with the culture, how a controls review is taken by the organization, to what are the areas that you have identified as key functions, what are the staffing arrangements you've made to ensure that you do a robust financial controls review, to what are the reporting deliverables that you produce, and who are the people who are involved in that. So I'm moving a little bit from financial controls to risk, and I would say that risk management is really, I don't know whether to call it a subset or whether it is something that goes hand in hand. But really, in the US at least, during the time of Sarbanes-Oxley and so on, when it started, financial controls review actually started off as process risk reviews. So that was what they used to call it. In fact, I was working for a division within Arthur Andersen which is called risk consulting. This was pre-Enron itself. So already I think the US corporations had woken up to the fact that really risk management is the area where organizations have to move towards, and really that is what I think we'll also have to take away from the journey of IFC, because I feel that more and more IFC is moving towards this very virgin and yet promising area of risk management. I think if I am sitting here as a CEO or a CFO of a company and there are certain corporate goals for me everything starts from what are all the risks that I have to being able to achieve this operating plan or a budget or a target or what my corporate goal is. And if you are going to fast forward 10 years from now, I think we would have moved beyond IFC, and it will be somewhere in the risk domain that we'll all be operating. So I would really like you to, as a professional opportunity, I think this is opening up a lot more for mid-size and growing small companies, that they want professional members of our profession to assist them more and more with not doing just post-mortem analysis of transactions, but being able to put a framework in place which will help them create a structure and say that, okay, tomorrow I have a sudden spike in my dispatches and suddenly I need to stock up, my supply chain is so tight that I operate on a just-in-time basis. My working capital turn is only 7 times, I want to take it up to 11 times. I think it's very important for us to be able to understand this, because we understand it from a cash flow standpoint. We are the ones who prepare or audit and review balance sheets for them. So a simple advice for the client on saying that, okay, I want to increase my working capital turn, has implications on his leverage, it has implications on his profitability, it has implications on his ability to manage the supplier's financial position. And this is exactly what risk is. This is also exactly how you help him plan for his financial reporting also, because a balance sheet is what helps him go and raise financing in the market, but is it going to be at the cost of increasing the leverage in my business and driving it to a point of risk where there is no return? I think it's really moving to a consulting framework. It's no longer just review of documentation or performing a test of transactions. It is really becoming a consulting profession, and risk management is going to be at the forefront of this, which is why I wanted to introduce the process of risk. And again, I'm going to just keep going forward so that I talk about, this is a sampling that I think we've already discussed about, but it's, again, not to overemphasize the point, but a very, very well written part of the guidance note that we all should go look at. This is one of my deliverables from a live client that we worked on, where we did a full internal financial control engagement. FSCP means financial statement closing process. So we went through each process, and you will see the way this table is laid out itself. There are major processes for companies, there are sub-processes within that, and then there is a control objective and a control activity, and this is what constitutes a control environment. So what is the objective of me doing this particular study? To ensure that I have, again, all of what is there in the control objective can be tied up to one or more of audit assertions that we talked about earlier, whether it is completeness, accuracy, rights and obligations, and so on. So each of these will go back to what exact audit assertion are you addressing, and what is the control activity that you have observed in this organization which is addressing that, and then is it adequate or not. So that part I mean, there was not enough space in this table, but then there is another section which says, okay, this is therefore rated as a high risk or a low risk. Here I have just shown what is the sample size that I have looked at, what is, whether it's a manual or an automated control, and what is the frequency. If you look at this, or rather if I say if the management looks at this, they get a very good grasp on whether they feel that there is a design lack in this particular function or not. I mean, anytime you look at what a manual function is, and I gave you the example of a company that does say 2 lakh invoices dispatch, and if you go and tell that company that, you know what, all your inter-depot transfers are all happening through manual invoices, if I am a CEO or a procurement manager, a commercial manager or a CFO, immediately my antenna would go up and say that, you know, a few thousand invoices of value of a few crores are all going through manual adjustments, which means that my month-end close is not really showing my true intercompany balances, which is a worry for me. I don't know how much of my actual inventory is in transit, what is my adjustment, say goods are getting returned, I don't even know whether it's all been accounted within the exact time. So given the size of the organization, it really triggers a discussion on whether this control is something to be arrested. Is it something that out of a few crore invoices you have a few hundred intercompany transactions which value is not really material for me, therefore the cost of putting another SAP terminal there and making this an automated control is not really worth my time. I'm willing to live with that level of discrepancy, which means that on a rotation basis I will have an auditor go do a physical audit of that particular depot or those set of depots once in 6 months. So then I create a plan. See, then it becomes a very structured discussion. I've gone up to the sub-process level, determined where my weakness is, and then I'm finding my own mitigation mechanism and doing a cost-benefit analysis and saying I can live with this risk or I cannot live with this risk. And obviously, a stat auditor will then come in and take the same call and say that, you know, your procedures performed are adequate for me to give my opinion, or they can say that no, I need to test this further and see whether this will have an impact on my financial reporting. It really becomes a well laid out process for you to then follow up and make structured decisions on. And if you do that on a consistent basis in a scheduled manner, then you really achieve the purpose of an internal financial control. See, a lot of what I'm saying is premised on the assumption that you are a little familiar with how an internal financial control process works. If not, I've prepared all the slides which will start talking about what is internal financial control. I'm glossing over all of that, but if you feel that a few things are going above your head, please start sequentially going through these slides. I'll definitely leave a copy with you. I just wanted to touch upon the more important aspects and discussions, and again, please interrupt me. A lot of people are only observing, but if you have any comments to make, there's something for the rest of the audience to learn, I would really love to share that. Again, I've put out a lot of processes here because I just wanted, see, this will teach you a lot more of what you actually read in the guidance note by practically looking at. So this is a live example actually of a company. So if you read the guidance note, all the rules, and then relate it back to a deliverable like this, I think it will tell you exactly what that guidance note or the rule is trying to communicate to you. I don't know whether this link will work. Yeah, it's opening up. So what I did was I also attached, removed the name of the company and so on, but so we talked about internal financial control, we talked about control environment, right? Now this has to translate at the ground level into a real guide for somebody who's operating a particular process. So I took an example of a company for whom we had designed an SOP, standard operating procedures, for each process. We actually wrote their entire SOP manual. This for the company is what translates my deliverable of IFC into day-to-day functioning of that company. So we actually went and did a study for several months of that company. Process by process, we wrote SOPs for them, and then educated their process owners and the teams which they had in each of these processes to tell them this is the policy of the company. Obviously, it flows top down. So this is what the board has set as the policies and procedures coming out of your IFC requirement, and these are the procedures you need to follow. And if I am coming in as a reviewer or a stat auditor or the management itself in whatever way, I will then make this the basis for determining whether you have actually followed your control objective, and then I'll perform my test of controls activity based on what your SOP is saying, and then I'll put all kinds of scenarios in this which you will encounter on a day-to-day basis. So I have put this also, and I have shared these slides also. I just pulled out one process for the treasury department, and this was specifically a company that is very cash rich and invests very high liquidity company. I don't want to call it cash rich. Liquidity is very key to them, and therefore they need to park their money in investments, and therefore we have put a very detailed processes in their SAP environment on how they deal with investments, redemption of the investments, and so on, and what are all the workflows that are arising out of that for them for each of these functions. And also very importantly, what are the accounting entries, because this is the F&A team is also part of this. And therefore, for each scenario, what is the accounting entry that you will be booking? This is just one small sliver that I have taken from that entire report. And the responsibility metrics. I will show another metrics later on, but the responsibility metrics as to which department, what part of this process falls with which department should be responsible for it. So please go through this as one sample SOP. There are several like this that we did for the company, but this will give you a chance to say, okay, I as a management, I like this IFC, I want to start implementing it. Now I have to start writing my SOPs, and therefore that is really the beginning of my educating the rest of my organization. I thought I would show a flavor of that. I have put several process maps also here. Again, I am not going to talk about all of these, but again from another live client, where this is a different client actually. Process by process, we drew out a flowchart, and this is a very standard way of getting into an IFC engagement with any client. This is one of the key byproducts or the deliverable for the client, where you start walking them through scenarios. So basically, flowcharting it gives you a very good snapshot. The SOP is more, it goes granular, and like I said, it shows the workflow, it shows accounting entries, it shows the responsibility metrics and so on. But if you have to do a walkthrough of the design of controls, then you generally start, if I'm a start auditor of a company, and then during my 2 months engagement, I have to convince myself that this process is working well. I'll start with the flow map and say, okay, let me do a flow of your design and see if it's functioning as it's intended, and then look at the documentation which you've created to see whether you've chosen adequate samples, whether you've taken cognizance of all the SOP steps that were performed, and then at a high level, do all your SOPs meet the control environment that has been set by the board. So I think you start to get a picture of what this whole IFC engagement can look like. Again, I put several different processes here. I thought real examples will help you get it. So I put HR, I put CapEx here, so you can go through that. I told you I'll show you a responsibility metric, so that's another chart. I think I'm going to wrap up quickly after this. For those of you who are looking at the watch, we won't be here too long. So again, those same processes for which flowcharts were there, this is the risk control matrix, and this is again self-explanatory, but this is a different way of presenting what I had shown you in a tabular form earlier, but I have shown everything that's done here, including the assertions that we are fulfilling through a particular function, again whether it's manual or automatic, what are the test procedures, what are the steps you took, what is the result. The only thing that I have not shown here is the actual samples that we tested to get this, and that is the back paper work for this. So I would urge you to go through all of this. See, we are all, if it was a CA student body here, I'll start walking through each of this. I'm going with the assumptions that you already know all of this. In fact, you will not tolerate my voice more if I start explaining each of these lines for you. But please go through all of these deliverables. I'm leaving a copy, and this is another important. So if somebody engages you to create an IFC manual for them, this is one of the key important deliverables that you will have to create for them, because this makes a walkthrough of the design and then controls tests very, very simple. You just mechanically start following all of this. I'm going to show you some slides from a recent engagement that I earlier talked to you about, where this is IFC plus, and I strongly believe that IFC is just one bus stop in this journey. We are going to progress further, and we are early days in IFC, and like some of you alluded, management is also, the board is only waking up to the risks in financial reporting. And like I started this whole presentation with, the business side of things is moving at a tremendous pace right now, and financial reporting is struggling to keep up with that. And so as these challenges start to surmount, I think the profession is, or rather the requirements under law is also going to go further, and therefore the profession is also going to go further than where we are today. And if all you young chartered accountants are looking at, where should I set my sights on, I would say risk management is something that you should really set your eyes on. Senior managements and boards are going to find this extremely valuable. They need financial accounting expertise to do a good risk management framework. Take it from me, it's not something that an MBA can just come and do. You need real audit experience, you need real controls testing experience, you really need to know statutes. I don't think there is anybody better placed than us to be able to perform that role. Just a few slides again. Somebody in this room must be very familiar with all this, but you want to talk about it or no? Yeah, he did a phenomenal job as part of this engagement. So what we have shown here is, okay, this is a company, and again, this is beyond financial reporting. Now I think I've financial reporting, IFC as a topic is done. I just want to look ahead a little bit. So this is beyond just financial reporting. This is really enterprise risk management, and this is a company that wanted us to put a risk management framework in place and help them think through how they should address key risks in being able to achieve their goals. And that's why this exercise was done for them over a few months, and we came up with certain risks, and we came up with a scoring mechanism for them, and we had our own rating mechanism to say that that translates into a really high risk area or a low risk area. And then if you just look at this chart, very quickly your eyes will go towards competition risk, and you will start to then dig into what are those sub risks. So these are about 14 risks that we prepared for the client, but there are 65 or 70 sub risks within this. So then the board's discussion is immediately about competition risk. Okay, why is such a high score? What is really happening there, and how significant is it for me to lose an account? Since the discussion gravitates towards, do I have enough people being able to address this risk? And we all have to respect, if we are from the auditing community, we all have to respect that the client always knows more than us. They know the business much more than us. They have seen through every kind of challenge. You can probably advise them and say that, in a different client, I saw this scenario which can play out here, but I don't think you can ever substitute their knowledge in the company better. For example, in this company, I can't go and tell them, I know your competition better than you. Impossible. But what this is doing is, it's showing them a framework and a rating mechanism where they then start to address competition as an important risk. And then the discussion becomes, do I have enough commercial managers and sales personnel out there to win the next big contract? Is internet, for example, taking away? Is there a disruptor like e-commerce which is taking away my business? Am I prepared for the next wave of innovation that's coming, or whatever it can be, depending on which industry it is? So we help them create this risk map. We call it a risk register, and then put that into a easy visual, and then sub risks for each of those risks. So A here was vendor supplier risk, and then I've gone into various sub risks within the vendor supplier risk. This is just a legend. So this then gives me an idea of how many of my 14 risks are really in the red category. It's a very interesting engagement because, and it's only partly done because this client also said a very interesting point, and this is why, you know, every client interaction you learn something new. I have done several risk engagements, but when I went and presented it to the client, he said, this is all beautiful. If there are low risks individually, can you do a correlation and tell me which of these risks together can become a medium or a high risk? It's a very statistical question. You need a lot of data to mine, and we had data analysts as part of our team to actually do this exercise. We had statisticians involved in this exercise. We did some predictive analysis for them. Some qualitative risks were scored. So it was a very interesting engagement. But really, this is a very live, what he asked was a very, very fundamental question, because I think a lot of us would have talked about a black swan analysis, right? We talked about that, basically, I don't know how many of you know what a black swan is. It's used a lot in the trading world. Is there a culmination of events that can really magnify to such an extent that it can really boomerang on my business and just create a very big impact? That one black swan which nobody has seen, but it exists somewhere. It comes out to play. Like the 500-year flood situation that people talk about. That one big event which will never occur on a daily basis, but somehow, sometime, once in a blue moon, that will occur, and its impact will be so big that it can really cause extinction of my business. So it was a very interesting thing. I don't think we've solved this problem yet, but that is exactly what has happened in every single crisis, whether it was in the 1987 Black Monday crisis in Wall Street, or whether it was again this 2008 crisis, or the scam that happened in the early 90s in India also, the fair growth and can bank. It was all really one small trigger which set off, every vulnerability started playing out at the same time. So that is exactly what happened for me. Personal experience was 2008 and when Lehman Brothers went down, because every single risk that we thought individually was a manageable risk suddenly all came together and it became an unmanageable risk where we were absolutely caught out in the cold, didn't know how to resolve this. So this can throw up very interesting possibilities, and again, financial reporting is one aspect of it. It's only a subset of what this risk management is, because arising out of this, okay, is there a possibility of a misstatement in my balance sheet? Is the control environment working well? All that is fine, but in my head as a CEO or a board member or a chairman of the risk management committee, it is not only financial reporting. That is one thing I have to be diligent about, but what about the fundamental of my business itself? I think we are very well placed to be able to handhold the management in saying that yes, financial reporting wise we've got you covered, but knowing financial accounting very well, we also can help you with statistical analysis of your data. And that is what this exercise threw a challenge to us, and we took it up and did it, which is what comes to my last slide of the day. I just want to leave you with where I think we are heading. There are several well-informed minds here. I would really, if anybody has comments on this, please do share. But I can tell you that I have worked on all of these engagements at least at one point of time in the last 2 years. And I have been in several discussions with senior management of very large companies also, who get more excited about these satellites I put here than about an audit. I'm sure you all, none of this is new to you, but this is where I think our profession should head. This is where professional opportunities will start to emerge very soon. For some of us, some of large firms, it's already there. business process engineering was a very, very important word 10, 15 years ago. Ma'am capsuled it in another jargon. She called it change agency. SDLC, some of you who are familiar with IT audits, COSO framework and so on, you know what an SDLC, Systems Development Life Cycle and so on. But all of those fit into either a risk management or a control self-assessment in various avatars. But risk management, I talked about it in quite a bit of detail. I'll just talk for a few minutes on the other topics. Data analytics is very, very key. I think it's an overused and abused word, but really the amount of data that's getting generated today, every management feels that they have to be on top of it. And putting an MIS framework in place, creating a structure for this, I think we as financial accountants, if we can help a company culminate so many millions of transactions into a nice balance sheet, I don't think there's anybody else who's better equipped than us to be able to analyze data and put it in a capsule that a company can then analyze in whatever meaningful way. I have helped companies, I have helped private equity firms actually look at data within their companies and see if there are opportunities for them to enhance, because I said that I had done a lot of operational work in the portfolio companies that we invested into. A lot of capacity productivity improvements that we've done. We used rudimentary data analytics tools back in the days. I'm talking about 2009 and 10. But today you have Hadoop, you have SAP HANA, which is the latest ERP that's come into the market. These are all coming with built-in data analytics tools. I'm part of a project where we have built robotics. We built bots, we call it bots, which basically throw up real-time data that the management needs to look at. We've helped a company build a data war room, as they call it. There was a company in Chennai which has done it so well that business school in the US has used it as a case study, and I literally went to the MD's room and he's got a huge 70-inch monitor. He's got about 6-7 plants, and within the plant, each mill or a component of the plant, how it is operating, it's throwing up metrics, engineering metrics, it's throwing up financial metrics to him. And he's got a touch screen now also, he can drill into it and see the data. And it goes down to your SAP records also. It's mind-blowing that the company here is doing it. I had seen it in the US. We wanted to invest into a shale oil company. So I saw this in Houston 10, 12 years ago, where by that time this was, at least in the oil and gas industry, this had evolved quite a bit from an engineering standpoint, not financial. But to see it in a Chennai company which had done it for both financial and non-financial, and it was really phenomenal. Control self-assessment basically means that management is constantly doing this exercise which we are all expected to do. So you can treat this slide as a very optimistic slide of the future, or you can treat it as a very depressing slide that our profession can even go out of date. Depends on which way you want to look at it. But there is a company in India which does CSA so beautifully, and I don't want to name these companies, but I swear that I'm giving you real examples and not fictitious conversations. But they take CSA so seriously, and they've done so many improvements themselves constantly. They are a company which uses IDEA, which is an analytical tool. It's a tool that helps you build and write queries on a continuous basis, and they've improved this tool so much for their own benefit. And this company, again, I give you the example of the cement dispatch from a depot. So if they get a new order from a customer, and if the dispatch has not happened from the nearest depot, which will optimize or minimize their freight cost, in 15 minutes the commercial manager and the chief internal auditor get an alarm saying, was this signed off as an exception by the management, or did the local management just take a call which was not the most prudent or the smartest call that they should have. This all came out of doing a continuous self-assessment of their control framework, control activities, rating themselves, seeing how can I improve it. This is exactly Six Sigma which is playing out in the control side. Six Sigma again pans everything, but this is just a subset of that, which is control self-assessment. And so this is both a financial reporting aid, this is also business improvement aid. So it serves both purposes simultaneously. There are a lot of opportunities available in this. Again, more and more mid-sized clients are also going to start needing this, because the kind of growth that we're going to see over the next 10 years, companies need this. I mean, I talk to a lot of private equity companies in India, and I have done private equity back in the US also, where if you say that, you know, my company is going to grow at 8 to 10% top line, in the US it's like phenomenal, out of the, I mean, it's really out of the range, it's an outlier. Here companies say, I'm going to double my revenue in 3 years. That's the pace of growth that India is seeing right now. And when transactions start growing at this rate, financial reporting, controls, everything has to keep pace. So again, I'm coming back to the same point that governance means your governance also has to keep pace with your business, and you can't do one at the cost of the other. Remote process automation is, people use various words for this. Some people call it artificial intelligence, some people call it bots, but basically it all means the same thing. There is an interesting project that we worked on where I set up the data center in India, which helped finalize the financial accounts of a global company, all based out of Chennai. So literally 75 to 80 trial balances across several geographies are now getting processed in Chennai. So the CFO of this company, the global CFO, came to Chennai. He said, very well done, we done a very good job for them. The transition went very smoothly. We sent about 45-50 people across the world to so many locations. They trained on the job, they brought it here. The typical, you eliminated jobs in the US, brought it here. It was a cost arbitrage for them. But you know, at the end of the day, what he said, you've done this work, very good, well done. But really, this is only the beginning for me. What I really want to do now is look at each sub-process and start to automate each of these processes, and I need more cost savings. And what he actually did was, he found out that there were about 30 or 40 people across the world, across so many geographies, who were doing simple things like bank reconciliation. And he configured all this in his SAP system and eliminated all of those jobs. He said, bank statements are getting generated online, my ledgers are all online, the reconciliation has to happen automatically and throughout the exceptions. Where is the need for a manual intervention here? So there is one person sitting in India who is responsible for BRS for this company across the globe. And this was being done by, I don't know how many, 30, 40, 50 people. Straight away gone, those jobs are gone. So that is going to be the future. And I still remember Nandan Nilekani came to Chennai once and spoke. There's a very nice, interesting body here called Chennai International Center. They bring in very interesting speakers. And the first session of this 3 years ago was Mr. Nandan Nilekani, and he said, change and automation is coming to you so fast that you're not even going to be able to realize it. And I think we have a very, very important role to play in this, because once you start falling into the framework and structure of an IFC, walking through an automation process for a client or doing the checks and validating the automation, it is all something that I don't think anybody can do it better than an auditor. So please start reading up, knowing more, looking at tools specifically, what is the level of automation that's happening. These are all emerging areas which are not going to stay emerging for very long. They're going to become mainstay very soon. So on this note, I'll end this presentation. Thank you so much. If there are any questions, I'm happy to take them. Otherwise, I've shared my slides.
What we are seeing is a plain vanilla type of a presentation. What ideally I would expect it is to be industry specific, more industries to cover, so that me as a person should really take away something out of this. So I think institute should help people take that piece also. Of course, not from me perspectively. Down the line, I would like a full day session of
Sure.
IFC, so that it really gives us some flair of what we actually hear from you.
Yeah, I think that's a fantastic suggestion, and somebody like ma'am would have done a lot of work. I mean, there'll be a repository of knowledge. I'm just using ma'am as one example, but I'm sure a lot of you here, there are a lot of, I can share so many industry specific live deliverable reports. I can whitewash the name and share real practical instances. And what you're saying is absolutely true. we then can make IFC an important daily session, and you can build the implementation guides for specific areas that you feel are very important to look at. It's a wonderful suggestion.
I'm waiting for people to finish questions.
Anybody else? Any other comments?
Sir, you were promising time and again that the slide would be available. Whenever I go to the site, I don't think where I can, pull out the past repository.
No, I'm
Can
not
I
sure.
respond?
This is
Can
my
I
first
respond?
time, so I don't know.
Okay. Many a time, if the slides are not in hard copy, it gets difficult to distribute to the participants. What happens is the speakers give it to the SIRC. It is not loaded on the site. You have to follow up with the SIRC people and give your email to get it. That gap is still there. It's been there for years and it still exists. There is no common e-room where we can share these slides. That is not available yet.
But in Bangalore, I'm sitting here, I can pull out, so many beautiful files from Bangalore. If I can do
I'm just telling you what is happening here.
This is a bigger center than Bangalore. I think we should.
No, I'm not an SIRC representative. You should talk to the right
Tell the
people.
management here, yeah.
Should talk to the right people. And sir, we organized industry-specific programs 3 years ago. And for each industry session, we had 10 participants. We had called industry experts to come spend their time. Half a day we had these programs, CPE programs, and there was only 10 people who participated. So that's the record of participation so far. So having organized some programs as resource persons here, I know the background, and I'm sure if that interest is evinced by people, the institute or anybody, why the Chamber of Commerce as well with whom I work, they should be interested in giving these programs. I hope I have responded to you. Friends, what we have had here is a session which is not out of preparation from any of the guides, but out of the rich experience and knowledge which Gokul has shared today. It is rather sad that we don't have many people participating in these kind of sessions, and he has taken the entire CP program to a different level because of his rich experience and the kind of examples he has shared. I only wish many more programs like this come, and one should appreciate the fact that he has spared time to get this ready and share it with everybody here. I have attended various IFC controls sessions here, but this one is rich with all his experience, and not only experience in rendering these assignments. Very rarely you get a speaker who has an industry experience and an MBA background who comes to our institute to speak, and I think we are all blessed to have this session here today. I had declined one of the global calls today, and I'll face the music tomorrow morning with the LCSP because Gokul made me sit here for the program. Very rarely, there will be an interested set of audience, but I should congratulate each of you for the absorbed participation you have all had. Let me just give one closing tip. In an audit committee or a board, the enterprise risk advisory presentation by auditors of IFC get 2.5 hours of the audit committee, and the statutory auditor gets 10 minutes to rush with their presentation. That's the kind of importance this part of the profession will get with the board. So with that note, thanks Gokul.
Thank you, ma'am.